Time now for today's Market Movers with easy-to-follow futures and options trades from CMEGroup.
Welcome to Market Movers. I'm Jim Urio, and we're a couple days away from the most significant data point of the month, and that's the June U.S. jobs report number. We'll be looking at using weekly S&P options as a way to hedge risk or increase exposure to this event. Since we're talking about equity indexes today, I want to quickly mention that the Russell 2000 index comes back to the CME starting July 10th, and we're going to be watching it very closely. So let's get right to this. Joining me is Scott Martin, Chief Investment Officer at Kingsview Asset Management.
Hi,
Scott.
Jim.
Hi. So the last three jobs numbers have ranged between very disappointing to just mildly disappointing, nothing better than that. So what do you think of this one, and does it even matter in the context of what's coming out of Washington?
Disappointing? Yeah. That seems like the flavor that we've been seeing lately. But what's interesting to me is it maybe isn't just the jobs report, but if you put it to the GDP reports, if you put it to consumer confidence numbers, consumer spending numbers, it's a mixed bag at best, which to me is a little bit of a surprise considering all the rhetoric we've heard and all the promises that were at least made from the stock market rallying earlier this year.
But I see the stock market rallying, and I have to think a little bit is that the market doesn't believe the Fed as much as the Fed wants them to about the tightening cycle, yes?
It's very true, and we saw some comments today about the contradictions going on within the Fed itself about how to unwind that, $5 trillion balance sheet. Throw a couple $1 trillion out there, see what happens. So the reality is the Fed is fighting themselves internally and fighting, I believe, what's a mediocre economic data situation.
And start thinking about it now. At the end of this, I'm going to ask you about Washington and what that could do to make this boost the stock market or not. But before we dive into our trade discussions, I'd like to point out that as with all market movers, it's important to view these trades as examples that allow you to see different ways to use futures and option products to manage risk or create additional trade opportunities, not as recommendations or advice. Prices and movements are going to vary. When we're looking at this now, the SEP ES contract is trading at about 24.28. Scott.
So as usual, when I think about exposure and I think about positionings leading into a great market moving event like the non-farm payrolls report on Friday, I punch up both call and put spreads, or calls and puts, just to see what the market is telling me about where the movement may be over the next, say, couple weeks. So specifically, Jim, I found something I like today, surprisingly, which is the week 2 Wednesday expiry. So this goes, as we like to do, beyond the non-farm payrolls report on Friday with a few more days for the market to digest it. And specifically, the week 2 Wednesday put spread, the 2420, 2400 range, buying it for about 4 ticks. So it expires on July 12th. And it has the underlying, as you mentioned, at 24.28. It's going to risk 200 to make a potential 800 if it fills out that range that we put in just late at the end of last month in June as the market sold off because there was some nervousness at the end of the quarter.
I like the way you're doing it. I like the Wednesday a lot because, as we've mentioned a bunch of times, it sometimes takes the market a couple days to digest the number and then pick which direction it wants to go. I'm looking at it a little differently. I'm looking at buying that same day, the Wednesday, week 2 July, 2440, 2450 call spread versus selling to help finance it the 2415, 2405 put spread. So we're selling a put spread and buying a call spread, so you get it a lot cheaper. This trade's max gain is 425 compared to a max loss of 575. And I understand that the max loss is a little bit higher, but those strikes are a little bit further away than the call strikes are. Thoughts?
I enjoy it because you're operating within a nice range there. And that's important, I believe, for the current market environment, which underlying, and day to day, there's been a ton of volatility. But if you look over the course of a period, whether it's a week, a day, a month, whatever it is, the market tends to not really have gone many places. So you have some intraday volatility that you can utilize to your advantage. But overall, the market really hasn't gone anywhere.
What's more important, news coming out of Washington regarding policy or the aggregation of the current market data?
I think it's the market data right now because I believe the market is starting to realize that the boost out of D.C. that was supposed to come, every day that passes that we don't get any more progress on healthcare, tax reform, regulatory reform, you name it, the market knows it has to move on from that. And the way it's going to do that is with better economic fundamentals.
I think I like what you're saying with the caveat is that we're used to not getting anything out of Washington, so if we do, it might have a greater effect. Thanks for joining us in this special edition of Market Movers. I'm Jim Urio, where we're hoping to make you a better trader.